How well is Fidelity doing financially? Are they a solid and growing company? Hello, members, super savers, and bond course fans. I hope you're having a good week. And welcome to the second part of our mini broker series. As many of you know, we've talked a lot about Charles Schwab on this channel. So today's video will be about another leading broker that many in our community use, Fidelity Investments. Here are the three topics that we'll be covering in today's Fidelity video. 1. Who owns Fidelity and why do we know so little about how it's doing? 2. How does Fidelity make its money and is it really growing? And 3. Should you keep your money with Fidelity? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. So, based on this recent poll asking which brokerage company do you have most of your money with, Fidelity seems to be very popular with many in our Diamond NestEgg community. Fidelity Investments, formerly known as FMR, Fidelity Management and Research, is one of the largest and best-known American asset management firms. More on this later. It was founded in 1946 in Boston, Massachusetts, and is still headquartered there to this day. Fidelity is privately held, and its ownership structure is fairly straightforward. 49% of the company is owned by the Johnson family, and 51% of the company is owned by current and former employees. And Fidelity's chairman, CEO, and president, Abigail Johnson, is actually one of the granddaughters of founder Edward C. Johnson II. Not all privately held companies are family-owned like Fidelity, though. Vanguard, for example, another asset manager that is a favorite with many in our Diamond NestEgg community. Vanguard falls into the privately held but not family-owned category. Its ownership structure is slightly more complex than Fidelity's here. Vanguard folks, drop a comment below if you want us to do a similar video for you like we're doing for Fidelity folks. So, there are three key characteristics of a privately held company like Fidelity and Vanguard, but I'll save their details for the separate Vanguard video if there's enough interest. 1. Fidelity shares are not publicly traded on any stock exchange, meaning you and I can't just go out and buy Fidelity stock on Fidelity's platform or via any other broker. This also means that the ownership circle of Fidelity is much smaller and presumably more tightly controlled than for a public company of a similar size, which will most likely have millions of shareholder owners out there. Which brings us to 2. Because its shares are not publicly traded on any stock exchange, Fidelity is not legally required to make its financial and other information publicly available. With a much more circumscribed ownership circle as a private firm, there's just no need for Fidelity to keep a wide group of shareholders and the public at large informed about the minute details of how they're doing as a company. It's enough if the owners know, but they can decide amongst themselves how they want to keep each other up to date. Some of Fidelity's competitors, like Schwab, as well as iShares fund manager BlackRock, are publicly traded, though, with millions of shareholder owners, and as such are subject to the stringent disclosure requirements about their finances and other matters that the stock exchanges and the SEC, the Securities and Exchange Commission, impose on them. And again, this is to make sure that the current shareholders of listed companies like Schwab and BlackRock and the public at large as potential future shareholders can really understand how their company is doing. And because Fidelity shares are not publicly traded, and it's not legally required to make its financial and other information publicly available, this means that 3, we only know as much about Fidelity and its finances as it wants us to know. The good news is that Fidelity does disclose some numbers voluntarily, and while it's not nearly as detailed as the information published by publicly traded asset management companies like Schwab and BlackRock, we're fairly good detectives here at Diamond NestEgg. So we can still give you an overview of Fidelity's business and how they seem to be doing based on what we've been able to find, which is a great segue into the next section of today's video. Fidelity is the world's third largest asset manager with assets under management of about $5.3 trillion, just behind BlackRock and Vanguard, as you can see here. And for the more curious minds amongst us, here is the full list of the 10 largest asset managers globally as of the first quarter of this year. Fidelity makes its money from two primary income streams. The first is brokerage accounts. This includes individual retail investor accounts like mine, workplace plan participant accounts, meaning, for example, company-sponsored 401k accounts like the one that Marcus has from his job, as well as clearing and custody accounts. These last ones are accounts for clients of independent advisors, where the advisor has the client relationship, but Fidelity does the clearing and custody and provides a brokerage account and deposit services for a fee. And although they don't explicitly disclose it, we suspect this stream will also include the revenue earned from their wealth management and advisory arm. The second income stream comes from Fidelity's own investment products, mainly funds and ETFs. These are sold both to Fidelity's own clients and on the open market, meaning you can buy them from Schwab, Vanguard, and other brokerage platforms as well. Included in this category is Fidelity's largest fund, the Fidelity 500 Index Fund, FXAIX, with $561 billion in total assets at the end of July 2024. Unfortunately, Fidelity does not disclose revenues and profits from each of these income streams by business line. I would have really loved to see that, and I'm sure I'm not the only one. But as I mentioned earlier, because Fidelity is privately held, they have much more discretion in what they choose to share with the public than their publicly traded counterparts. In fact, this discretion is one of the primary reasons some companies choose to stay private. Fidelity does disclose some key financial metrics, though. These include the number of accounts, assets held, as well as their overall revenue, operating expense, and the resulting operating income. So let's start with the number of accounts first. The number of accounts at Fidelity appear to have grown nicely over the past few years, specifically from 2019 to 2023. In this row are the number of retail accounts in millions. In this row are the number of workplace plan participant accounts in millions. And in this row are the number of clearing and custody accounts in millions. So, Fidelity closed last year out with 38.7 million retail accounts, 43.2 million workplace plan participant accounts, and 8.7 million clearing and custody accounts. That represents a compound annual growth rate since 2019 of 14.90% for retail accounts, 9.35% for workplace plan participant accounts, and 3.97% for clearing and custody accounts. Not too shabby. Moving on to assets now. Assets have also experienced double-digit compound annual growth rates in recent years, again specifically between 2019 and 2023. In this first row, we have Fidelity's assets under administration in billions of dollars. These are, in essence, all assets that are being held in Fidelity accounts, including individual stocks and bonds, as well as Fidelity funds and ETFs, or third-party funds and investment products. In this row, we have their discretionary assets in billions of dollars. This second row is a subset of the assets under administration here, and in essence refers to assets where Fidelity has some discretion to make investment decisions. This would be the case, for example, in their own funds and ETFs, where Fidelity decides on what to buy, what to sell, and what to hold. In the industry, like in this ranking that I showed you earlier, these are often also called assets under management. Discretionary assets are usually shown separately in the financials of brokerage firms, as they tend to generate more income for the broker than mere assets under administration, where the firm may earn some slim deposit fee or maybe even nothing, such as for treasuries in many cases. And in this final row, we have their net asset flows, also in billions of dollars, meaning how much in net new assets they received each year. This is a key metric for growth in asset managers. We combed through lots of data to give you this financial overview. As I said, we're good detectives here at Diamond NestEgg. And the good news is that there is an overall upward trend across all the metrics we've shown you here. You can see that again here in the healthy compound annual growth rates for the assets held at Fidelity. Fidelity also seems to be quite proud of their client engagement and heavy investment into technology. They prominently report on their progress in digital delivery in their annual reports, as you can see from these statistics here in their latest quarterly update, for example. Again, double-digit year-over-year increases. What Fidelity does not prominently report on, however, is their profitability, their bottom line, the money that goes to the owners at the end of the year. But as I mentioned earlier, they do disclose revenue, operating expense, and the resulting operating income, which should give us a high-level overview of how they're doing. Revenue, operating expense, and operating income are all moving in an upward direction. As before, we have data from 2019 through to 2023. This row shows their revenue for each year. This row shows their operating expense, and this row shows their resulting operating income. And in this column, we have the compound annual growth rate over this time period. This here was as close to a profit and loss statement as we could find. Now, how does this compare to Schwab, right? Because I know some of you have accounts with both Fidelity and Schwab and are always interested in the comparison. Here's a 3-year comparison of both revenues and the operating income, or income before taxes, for Fidelity versus Schwab. From 2021, a good starting point in our view, not only because the worst of COVID was over by that year, but also because it was the first full year for the Schwab TD Ameritrade integration after the U.S. Department of Justice had just approved it the year before in mid-2020. So the blue line shows revenue for Fidelity. The green line shows the equivalent for Schwab, total net revenues. And what we see here is that while Fidelity's revenue has increased more or less consistently during this time, Schwab's total net revenue has not moved much at all over the 3 years, despite the TD Ameritrade merger. It did go up a little bit in 2022, but only to come back down in 2023. Similarly, if we look at operating income for Fidelity, this yellow line, versus income before taxes for Schwab, this red line here, Fidelity's operating income looks quite consistent and even a tad bit up, while Schwab's income before taxes has actually moved a bit in the opposite direction after a short bump upwards in 2022. And because I know this question will come up, this is not to say that you should move money out of Schwab and into Fidelity. Remember, Fidelity is private and we don't have the same level of disclosure we have for Schwab. Plus, we've talked extensively about broker safety and my view on SIPC coverage in these videos here already. Link below for your convenience. Rather, this comparison is here to show 2 key things with the data that we've been able to dig up. 1, Fidelity does appear to be growing steadily in terms of number of accounts, assets, revenue, and operating income over time. And yes, if measured by sheer volume of assets under management and revenue, Fidelity is the larger firm of the two. And 2, despite the TD Ameritrade merger, Schwab's total net revenue has not really moved. And in fact, its income before taxes has actually gone down a bit over the past 3 years. But on a 3-year average, Schwab was earning roughly the same absolute income before taxes that Fidelity got in operating income out of its larger asset and client base. So yes, in relative terms, Schwab has been the more profitable firm with the higher operating margin of the two. One more thing to keep in mind is that Fidelity, unlike Schwab, does not have a banking business. Those of you who've seen this recent Schwab video know that Schwab does have its own bank in the form of Schwab Bank, which has proven to be a thorn in its side since the Fed started raising interest rates in 2022. And these Schwab numbers here no doubt reflect some of the difficulties Schwab is seeing in its banking arm. And who knows, depending how they're positioned, Schwab may see an uptick in its profitability once the Fed starts lowering rates again, something that we will be watching with great interest here at Diamond NestEgg. But back to Fidelity. Because it does not have its own banking business, it works with a network of other banks, including JP Chase, Morgan Stanley, Goldman Sachs, and Citibank, to name just a few, to facilitate its cash management account program, as well as its FDIC-insured deposit sweep. Right, so now that we know that Fidelity has been a solid growing company over the past few years, as we've seen from all these numbers that we've been able to find and that we've shared with you, let's move on now to the next section of this video. If you're a Diamond NestEgg regular, I think you already suspect what my answer to this question will be. And let me preface this section with a reminder that Fidelity is a privately held company. And as customary, we do not have any ownership of, affiliation with, or sponsorship from any of the companies we talk about on this channel. Fidelity is my primary broker, and we have no plans to switch primary brokers at this point in time, based on everything we've just shared with you. I've been with Fidelity for a very long time, nearly 3 decades at this point. And in that time, I've passed over some attractive sign-up and switch bonuses from other brokers. I've seen brokers get acquired or go out of business, and I've even had an auto roll mix-up or two with Fidelity. But Fidelity remains a household name in the Lammer family. Marcus's 401k and HSA, health savings account, are also with Fidelity, and nearly all our kids have accounts with them as well. And the only one who doesn't have a Fidelity account yet is because he's too young to open one. I've also sent a number of friends, family, and clients their way over the decades. So clearly, I'm pretty happy with Fidelity overall, from their products, money market sweep, and T-bill auto roll feature to their customer service, fees, and technology. And in particular, I think they're a good brokerage company to start with if you're a beginner and or have a lot of questions that you want a human being to answer for you over the phone. If you fall into the lots of questions group though, just keep in mind that when it comes time to place your actual order, if you do it via a customer service representative over the phone rather than online yourself, you will need to pay an additional fee. In my mind, if you're an existing Fidelity customer who's as happy and or satisfied with them as we are, then there is no real reason to switch away from Fidelity now. Having said that, everyone's financial journey is different. As I've said before, if you have a specific interest in new issue corporate bonds and or municipal bonds, you may find that Schwab generally has a larger overall offering. Or perhaps you just like Schwab's friendly customer service and extensive research library. Or maybe you're looking for diversified low-cost funds and ETFs at Vanguard. Or you're a very advanced or international trader, in which case you may prefer someone like Interactive Brokers. Perhaps you just want to diversify and not keep all your money with one broker. We have some funds across all the leading brokers, primarily for the step-by-step tutorials we sometimes make on this channel. But generally speaking, a bit of diversification is usually not a bad thing. Fidelity remains our primary broker for now, though, and we'll keep watching for whatever publicly available data that they decide to publish to see how they're doing and whether they will continue to grow. And if you want to keep watching with us, then drop a comment below and let us know. So I hope you enjoyed this video and learned something new. And if you want to keep learning, and specifically about the easiest, safest, and most cost-effective way to start with bond investing while rates are attractive, then take a look at this video here on our 2024 bond courses. Or join our next live member Q&A on August 21st at 6 p.m. Eastern Time, 3 p.m. Pacific Time for all things fixed income, with highlights of the 2-year, 5-year, and 7-year T-note auctions. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. All right, member Super Savers and bond course fans, wishing you a wonderful rest of the week, and see you again very soon with more brand new wealth building content for your financial journey.